Hello and welcome to the Monday Futures Market Outlook for October 1st, 2012. This is Patrick Srezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. We're going to start off with a chart of the Euro FX futures and wanted to look at the idea that the entire pullback we've seen up till now is just forming a flagging formation after such a substantial run. With us seeing the 127.50 focal point continue to act like a support underneath, really at this juncture, if we see any bullish reversal back up, it would indicate that the Euro could go back to retest not only the highs that it put in at 132, but we could even potentially see retesting of the 133 to 135 zone where all the major highs have occurred earlier this year. Nonetheless, we see this morning a material bullish reversal on the upside, but it has yet to have any substantial follow through. So the early part of this week will tell us a lot as to whether or not the Euro can muster up enough strength to reverse off of these lows. The only point we would become technically concerned about the Euro would be if we saw material weakness below this 127.50 focal point. It's down there that we have to look at whether or not the trend has reversed. But really at this stage, so long as they continue to hold it in this way, we do have to give the benefit to the bulls. Next year, when we take a look at the 30-year Treasury bond, we were bullish to Treasury bonds over the last 2 weeks, looking for a short-term bottom off that 144.5 area. Really, at this juncture, we are becoming a little more neutral here. There's a potential for Treasury bonds to become quite bullish, but we are now approaching overhead resistance levels where if it was not going to break out, there's a mixed risk-reward proposition. So really at this stage, we are just want to taper off our view just a little bit, but overall we still are going to give the bond bulls the benefit of the doubt that they'll be able to approach the previous highs. One of the reasons this is because the 10-year Treasury bond continues to behave so positively. The biggest problem with the 30-year Treasury bond is that the more bullish commodities get, the greater the probability that inflation will be returning in the system, which is going to have a material impact on the pricing of the 30-year or the longest end of the yield curve. Nonetheless, we are going to we still give it the benefit of the doubt to reach those previous highs, but we're going to take a much more neutral stance on it. Next year, we're going to take a look at copper futures. You can see that over the last couple of weeks, copper was really just created a flagging formation, consolidating. And this morning, we're already seeing some bullish price action to give an indication that copper may attempt to break higher. If this break higher does gain any momentum, we could see copper head right back up toward the highs of the year, up around the $4 range, where we have that focal point. Really, at this stage, we'll see, and we are getting a signal. We want to now see that the bulls actually follow through on it and that doesn't immediately reverse back on the downside. Next year, I want to take a look at crude oil, and crude has made a pretty substantial correction over the last 2 weeks, but it has actually found support exactly where we were looking for it. This 88 to 90 level was where we were saying that if it is just a pullback, that this is where the support would come in. Our risk-reward proposition down at these levels is very good. We're now not suggesting here that we know that crude oil will not weaken further, but really at this stage, if it was going to turn bullish, this would be a place from which it would naturally do it. And so we're going to be watching to see how the bulls follow through. If we see any substantial progress to $94, $96 on the upside, that would give it the opportunity for crude oil to materially strengthen a little bit later on. But the longer it takes and hovers around this $92 to $94 area, the more likely it is for a retest along that support line. So let's just see whether or not the bulls can muster up some strength and follow through on the upside. Next year, I want to take a look at gold futures, and gold actually has held up very, very well. We were looking for a much deeper pullback back to even the 1700 level, and we saw nothing of the sort. At this stage, gold is already attempting to break above this 1800 level, where the highs all came in the earlier part of the year. At this stage, Even if we do have a bullish break on the upside, we certainly won't deny that it can actually move even at 50, 60, $70 on the upside if it manages to break 1800. But likely off of those highs, there will be pullbacks to accumulate on weakness. So chasing it higher may have a diminishing benefit. And so we are in the bigger picture bullish gold. And so it's just about trying to make a decision as to when it's worth entering into the gold market at this stage. We are again going to watch to see if it does break 1800. If it does, there could be $40, $50 on the upside, but we will still be looking to accumulate on weakness. So finally, when we take a look at the S&P 500 and try to look at where the stock market is actually heading, very similar to the way that the euro has been behaving, off of the 1475 highs, we have seen these pullbacks, but the pullbacks just qualify as a consolidation flagging formation that is simply being held to support along all of the previous highs that were put in prior months throughout the year. At this stage, if the market can bullishly reverse above the 1445 level on the upside off of these lows, there's definitely room for the market to not only double top retest its previous highs, but there's also scenarios from which we could even see 1500 on the upside of the S&P. Now, while we are just painting a bullish scenario right here, that does not make it a good idea in our opinion to be accumulating the stock market here. While the market certainly has the potential to make a short-term swing trade higher, which swing traders can certainly try to profit from, it is likely that a major high in the market will probably develop up along these levels. And so if you're chasing the market higher, and you probably may get stuck on the wrong side of the market, as later on in October, if not in early November, there probably will be some sort of a market correction of significance. And so really at this stage, while we do believe the stock market will go higher, we do not like the risk reward proposition of owning the market here. So let's make some key intermarket observations. First off, on the U.S. dollar, we do believe that the risk-reward proposition of owning U.S. dollars is good, even though it has now become very range-bound instead of bullish trending. While there is definitely room for the U.S. dollar to retest its lows, and we think the correction that we've already seen in the U.S. dollar has already priced in much of the weakness. Now, while certain people will argue that the U.S. dollar will weaken because of the Fed policy, one must recognize that the Eurozone and the US dollar is crossed against the euro in the majority of that index, and the Eurozone is going through the same money expansion and the same problems that the US is. And so we don't believe that the euro will substantially strengthen, nor will the yen substantially strengthen against the US dollar, and therefore the dollar index will probably be far more range bound and buy on dip on along the support lines will work well. For commodities, we are actually bigger picture starting to get bullish commodities, but we do believe that the risk reward on the short term is average, as many of them have already had material moves higher. We do want to see some sort of a buy on dip opportunity on commodities for us to change that risk reward proposition to good. In the bond market, we've went from being the risk reward proposition being good to just average, largely because those the 10-year and 30-year Treasury bonds are slowly approaching their highs of the year, and where there could be overhead resistance. And so we don't want to be over ambitious until we see really bullish price action. In the same degree, the stock markets, while we were suggesting both on the U.S. markets and if you look at the global markets that there could be short-term potential upside, we still do believe that the risk-reward proposition of the market is poor. And while we certainly can make some money on the short term on the upside, we're not overly ambitious to be going long the markets up at these higher levels. That was your Monday Futures Market Outlook. Thank you for joining me.